Welcome to Economics. Today we'll learn about fractional reserve banking, a fundamental concept in modern banking. Fractional reserve banking is a system where banks are required to hold only a fraction of their deposits as reserves and can lend out the rest. Let's break this down. Let's visualize this with a simple example. Imagine a bank receives a deposit of $1,000. If the reserve requirement is 10%, the bank must keep $100 as reserves and can lend out $900. The reserve requirement is set by the central bank and determines what percentage of deposits banks must hold in reserve. This percentage varies by country and can be adjusted to control the money supply. Let's look at some major central banks around the world that implement these reserve requirements. The Federal Reserve in the United States, the European Central Bank in Europe, the Bank of England in the UK, the Bank of Japan in Japan, the People's Bank of China in China, the Reserve Bank of Australia, and the Bank of Canada. But here's where it gets interesting. When the bank lends out that $900, the borrower spends it, and it gets deposited in another bank. That bank then keeps 10% as reserves and lends out the rest. This process creates more money in the economy. The money multiplier shows how much money can be created from each dollar of reserves. It's calculated as 1 divided by the reserve requirement ratio. Fractional reserve banking has important benefits. It allows banks to make loans, which promotes economic growth, enables the central bank to control money supply through reserve requirements, and helps maintain financial stability. However, fractional reserve banking also carries risks. Banks can face liquidity problems if many depositors want their money at the same time. This is known as a bank run. Banks must carefully balance lending with maintaining sufficient reserves. Let's consider a real-world example. If the Federal Reserve lowers the reserve requirement from 10% to 8%, banks can lend out more money, which can stimulate economic activity and increase the money supply in the economy. In summary, fractional reserve banking is a system where banks keep only a fraction of deposits as reserves and lend out the rest. This system enables economic growth through lending but requires careful regulation to maintain stability. Understanding fractional reserve banking is crucial to understanding how modern monetary systems work and how central banks influence economic activity. Thank you for learning with me today.